What comes to mind when you hear the term derivatives? If you are new to the subject, it can invoke an uneasy feeling, as many people have the belief that these types of instruments are complex, confusing, and difficult to understand. In this module, you will begin your journey to demystify derivatives and gain a foundational knowledge to understand the common derivative types, basic derivative concepts, and the accounting for derivatives as prescribed by ASC 815. Gap Dynamics has additional modules on embedded derivatives and hedge accounting. Before we get into the details of the training, let's take a step back to understand at a high level what derivatives are and what entities use them for. A derivative is a contract whose value is derived from an underlying asset. A basic example would be a contract that gives you the right to buy stock in a public company during a specified period of time. The underlying asset for which the derivative contract, in this case the option or right to buy stock, derives its value from, is the stock of the public company stated in the contract. In other words, as the stock price changes, the value of the contract giving you the right to purchase that stock is impacted. There are countless types of derivatives. In this module, you will learn about the most common types, which include options, swaps, and forwards and futures. Derivatives are typically highly leveraged. They provide exposure to economic risk without any significant upfront costs for entering into the transaction. A natural question that comes to mind is, why would an entity want to hold these instruments? There are two main reasons why derivatives are used by entities. Entities are exposed to a variety of risks for which they may look to minimize. Derivatives are often used to mitigate the financial risks that an entity is exposed to by holding derivatives whose risk is the opposite and offsets the inherent financial risks in the entity. The other predominant use of derivatives by an entity that we mentioned was for speculation purposes. In these instances, an entity may simply invest in a derivative hoping to profit as the underlying asset from which the derivative is deriving its value fluctuates. So that is the background behind what a derivative is and what they are typically used for. In the remainder of this module, we will build upon this to provide you with a foundational knowledge of accounting for derivatives. By the end of this module, you will be able to recognize common derivative instruments, identify the characteristics of a derivative instrument under ASC 815, recognize scope exceptions to derivative accounting under ASC 815, and recall the accounting for derivative instruments.